Hello students, welcome back to Global Online Kannada. So in this session, we are going to discuss very important expected MCQs on very important chapter, Dividend Theories. Okay, so if you are preparing from the management background, paper 2 for upcoming KSET examination, I would suggest you please watch this video till the end because these MCQs are very important to maximize your score, right? We are providing paper to complete course for management and commerce students as well for UGC NET as well as KSET examination. In this, the experts will be guiding you to maximize your score and as well as to qualify this examination with a good score and the confidence, right? In this course, you will be getting full syllabus video lectures which will cover your whole syllabus of paper 2 as well as complete syllabus notes which are covering the whole concepts of your syllabus, right? You can read those and you can cover your concepts. Mock tests will be provided to you. PYQs with explanation, doubt clearing sessions, marathons, these all things will be provided to you. So if you are seriously preparing for the examination, go and just give a message on this number. You can do WhatsApp message or WhatsApp call on this number and you can join the course. Okay. All right, so this is the first question on your screen. You have to give your answer in the comment box, whatever it is, A, B, C, D, just give your answer in the comment box, okay? Which of the following models explicitly supports the relevance of dividends? A, Walter and Garden models, hypothesis, residual theory only, or none of this. So right answer is option A, that is Walter and Garden's model. Okay, both Walter and Garden models conclude that dividend policy influences the firm value. Okay, because which is related to your retained earning, which is extra profit that company is having, right? Walter focuses on relationship between the R and K, the rate of return, the rate of investment, and the cost of equity, right? While Garden emphasizes the investor preferences for current dividends over the uncertain capital gains. So both are explained from the both way, right? And how they are explaining, that is the only result which is concluding that dividend policy is influencing the firm's value. Correct? So this theory is very important. Next, according to a firm's value is influenced primarily by A, dividend payout ratio, B, investment decisions, C, retained earnings, or D, dividend stability. So that is your investment decisions. Okay. Argue that firm value depends on its ability to generate earnings from investments. Correct. Dividend payout is irrelevant in perfect market, but the choice of investment projects directly determines the growth and valuation of the firm. So according to okay, what it is saying, that firm's values depend, okay, the firm's values depend on the firm's ability to generate the income from the investment, right? So how much the company is earning from the investment, okay, if it is positive, if it is more, then the firm's value is more. Okay, if the company is not able to generate the income from the investment, that means the company's value is not good. Okay, again, dividend payout is irrelevant in perfect market. Okay, what model is saying, that dividend payout, okay, is irrelevant in perfect market, but the choice of investment projects directly determines the growth and valuation of the firm. Because when we have a value, we earn profit. When we have extra profit, we give in the dividend payout, right? So is arguing that if the company's ability is good to earn the profit, earn the earnings or returns from the investment, that means dividend payout is possible. It is positive in that firm, right? That the hypothesis is trying to say. Which theory emphasizes that dividends are residual decisions? A, hypothesis, B, Walter's model, C, residual theory, or D, Garden's model. Okay, so right answer is option C, that is residual theory. All right, so residual theory states dividend should only be declared after financing all profitable investment. What does it mean? When you have profitable investment, the investment which is earning more profit or earning more return from that, okay, you should give preference to that things. Okay, and after that whatever is remaining you just provide that. The logic is that why it is saying shareholders benefit more from the reinvested earnings than from cash dividends if profitable opportunities exist. If the profitable opportunities are still exist, you should go for it. You should invest in that. You should give your extra earnings to that thing which is earning more profit, right? And remaining, if it is remains, then you can give to uh, the dividend payout and all. Okay, but first you should invest in that things which is profitable for the company, for the firm. Homemade individuals concept is associated with Walter's model, hypothesis, Gardner's model, or residual theory. So that is hypothesis. Hypothesis explains that shareholders can create their own dividends by selling part of their shares if they need cash, regardless of the firm's dividend policy. This supports the idea of dividend irrelevance. Which of the following assumptions is specific to Walter's model? A. No taxes exist. B. Financing is done only through retained earnings. C. Perfect capital markets. Or D. Investors are indifferent to dividends. Right answer is option B. That is financing is done only through retained earnings. Walter assumes that the finance of a firm, okay, that means the firm is financing only in the investment through the retained earnings, okay, without taking any extra money from the outside. That the Walter is assuming. What difference that makes? This makes the dividend policy directly linked with the investment decisions, okay, which creates the value of a firm, which create the goodwill of a firm. Getting it? So that means the Walter is saying companies should always give preference to the investments through their retained earnings, not to the extra money that company should take from the outside. Getting it? So whatever you have, just invest with that only. Don't take extra money. That the Walter is assuming in the simple word I'm telling you. Next question. The term bird in hand in Gardner's model refers to. What does it mean that birds in hand? A. Preferences for certain dividends over uncertain capital gains. B. Retention of earnings for future growth. C. Ignoring dividend payouts completely. Or D. Issuing bonus shares instead of dividend. What is it? Option A. Preferences for certain dividends over uncertain capital gains. That is your birds in hand, right? Metaphor birds in hand highlights that investors prefer assured present dividends rather than uncertain future returns. Getting it? So birds in hand, that means something you have in your hand already, that should be preferable by the investors. Okay, so investors prefer assured present dividends rather than the uncertain future returns. They don't trust in the future returns, okay, whether it will come or not, but they very much focus or very much interested or preferring to the things which is already the company is having in their hand. That means bird in hand. Okay, this preferences makes dividend policy an important determinant of stock price in the Gardner's model. Clear? Next question. Which dividend model considers growth by reinvestment of earning? A. hypothesis. B. Gordon's model. C. Walter's model. And D. Residual theory. That is your Gordon's model. Okay. Gordon's model directly links growth rate, that G is equal to BR, okay, to retention of earning. The reinvestment of profit increases the firm's growth prospects, which in turn enhances the share value of R is greater than K. That means return and the cost of equity. Clear? If a firm has no profitable investment opportunities, according to the residual theory, it should A. Retain all earnings, distribute earnings as a dividends, lower the cost of equity, or issue more equity shares. Okay, according to the residual theory. Okay, so it should be distributing earnings as a dividends. Okay, first they should distribute the earnings as a dividends, right? Residual theory suggests dividends should only be paid when there are no profitable investments to undertake, right? If the company has no earnings or no profitable earnings from the investment, then company should give the dividends first. In such cases, distributing the earning as a dividend in a shareholder's best interest rather than the retaining the ideal funds. Okay, so companies should not jump into the next investment or more investment than taking the money from the outside, and all these things should not work, will not work. So companies should give the more profits, okay, which the company is having into the dividend. Okay, which of the following dividend theories assumes a perfect capital market with rational investors? Hypothesis, Walter's model, Gardner's model, or residual theory? That is your hypothesis. Okay, hypothesis is built on the strict assumptions like perfect capital markets, rational investors, no transaction cost, and no taxes. Okay, these assumptions lead to conclusion that dividend policy is irrelevant. This is last question. The value of a firm in a Walters model depends upon A. Only dividend payout ratio, B. Relationship between R and K, C. Residual income after investment, and D. Perfect capital market conditions. I need answer of this question from you. Okay, just give your answer whatever it is in the comment box. In the next session I will give you the right answer, but before that I need the answer from your side. Okay,